Welcome to the Cardinal Commentary for the Foreign Equity Portfolios. U.S. President Donald Trump has initiated a global trade war that immediately caused havoc for consumers, governments, and stock markets in North America and around the world. An unpredictable stream of conflicting statements and policies, not to mention the on-again, off-again nature of the tariffs, has made them virtually impossible to navigate. Luckily for the rest of the world, it appears the tariffs are becoming increasingly unpopular within the Republican Party, which is why Trump recently announced a 90-day pause. And there's more reason for optimism. The global trade machine is simply too big to turn off with the flick of a tariff. A global trade war would cause so much economic pain and be so unpopular, we believe it won't happen. The longer the trade war persists, the greater the likely impact on consumers. For example, inflation will rise as the cost of many imported goods increases, and a slowing economy could also hurt global stock markets. We have researched the potential impact of the tariffs on our portfolios, and portfolio manager Terry Wong believes we are well positioned to withstand this threat.
Well, right now, the tariff situation doesn't apply to service industries. So a lot of our companies in our portfolio are service companies, so they don't really have exposure to tariffs. But those companies that have goods or export goods to the U.S. or import goods from the U.S. may have tariffs applied to them. Companies like Suncor that export oil to the U.S., obviously there is a chance that they might be tariffed.
It's practically impossible for a company to avoid the tariffs completely, but we believe Unilever comes close. Analyst David Amy says the British multinational consumer packaged goods provider has diverse operations with nearly 2/3 of its sales in emerging markets, and most of its manufacturing is done where they sell the product.
Over the long run, we think this is a great place to be, and it can deliver outsized growth. In particular, we really like their exposure to India, which is 12% of company revenue right now. India is one of the fastest growing economies in the world, and a growing middle and upper class should drive higher consumption growth in that country. And with Unilever's current market positioning in the country, it should benefit them.
14 of our companies increased their dividends in the first quarter, led by Oracle at 25%, followed closely by Applied Materials and Iberdrola. And all of those dividends have contributed to excellent returns net of fees over the last 2 decades. And here's the proof. If you had invested $500,000 in this portfolio in 2002, it would be worth more than $3.1 million today, outpacing what you would have earned in the benchmark by nearly $375,000. And all of this demonstrates our commitment to clients, a common sense path to long-term wealth. Because it works. And that's the Cardinal Commentary for our foreign equity portfolios. Thanks for joining us.